Case study number 1. To sell or not to sell. Doc and Dot McPeer purchased a single-family dwelling on Lakeshore Drive in LaPorte, Indiana in 1994. Now that's less than a year after the city adopted its first flood insurance rate map. Doc and Dot's house was built in 1977. According to the April 1, 1993 flood insurance rate map, their home is in flood zone AE. They have been required by their lending institution to carry $250,000 worth of flood insurance on their primary residence ever since they purchased it. The couple also decided to buy the maximum contents limit of $100,000 in order to more fully protect both their home and its possessions. Doc and Dot have benefited from subsidized pre-firm rates since 1994 while insuring their one-story, no-basement dwelling near the lake. They carry the policy's standard coverage A and B deductibles, and their policy comes up for renewal each October on the 15th. Prior to their October 2013 renewal, they paid an annual premium of $3,289. Doc and Dot's premium is based on the following. They have a single-family dwelling with one floor and no basement. It's pre-firm construction, and they carry the standard deductibles. Their home is in Zone AE, and they have $250,000 worth of coverage A and $100,000 worth of coverage B. Since most rating is now automated, many agents are not aware that the NFIP has a two-tiered rating approach. Most rating situations have both a basic insurance limits rate as well as an additional insurance limits rate. This chart illustrates the coverage limit breakpoints for each rate based on the type of structure. For example, in the case of a single-family dwelling, the basic insurance limits rate applies to the first $60,000 worth of coverage. The additional limits rate then applies to the next $190,000. Rates are per $100 of coverage. So the McPeer's premium is figured as follows. Let's first calculate the building premium. We'll take that $60,000 basic limits premium amount and multiply it by a 76-cent rate, and that'll equal $456 worth of basic limits premium. The remaining $190,000 is multiplied by a 77-cent rate, giving us a $1,463 additional limits premium. Now for the contents premium, let's take $25,000 times 96 cents to give us a $240 basic limits premium. The remaining $75,000 is multiplied by a $1.38 rate, giving us a $1,035 additional limits premium. Our annual subtotal between both building and contents comes to $3,194. We'll now add in coverage D, increased cost of compliance, which in this case is $55. And then finally we'll add in the federal policy fee of $40, bringing us a total amount due of $3,289. That $3,289 is the full subsidized premium for the McPeer's residence. Subsidized premium rates, like those the McPeers are using, are discounted rates that have been traditionally available for structures built before a community first adopted FEMA flood maps and guidelines. The subsidized rates are determined with limited underwriting information and typically do not reflect the full risk of flood loss. When the McPeer's policy came up for renewal in October 2013, since their home is their primary residence, they were able to still benefit from subsidized pre-firm rates since they continued to own their home as their primary residence. But some of the rating elements, as well as the rates, have changed. For example, effective October 1st, a reserve fund assessment became a part of their annual premium. Let's take a look at this year's rating approach. Some of the rates have increased, but those increases are not related to the Biggert-Waters Flood Insurance Reform Act. They just represent a typical annual increase that certain rating categories undergo. This year, the building premium is derived at by taking $60,000 times a 91-cent rate, giving us a $546 basic limits premium. The remaining $190,000 is still multiplied by the same 77-cent rate, giving us a $1,463 additional limits premium. On contents, we take $25,000 times $1.15, giving us a $288 basic limits premium, and then the remaining $75,000 is multiplied by a $1.38 rate, giving us a $1,035 additional limits premium. Our annual subtotal, both building and contents, comes to $3,332. Add in our ICC premium of $55, and now for the first time, we'll add in the 5% reserve fund assessment, which this year totals $169. Finally, we'll add in our federal policy fee of $44, that's up from $40 a year ago, giving us a total amount due of $3,600. Now, just before their policy renewed in October, Doc & Dot decided to sell their home. Once it sells, the new owner will not be able to take advantage of subsidized rates, but will have to pay full risk rates. An elevation certificate is required to determine the dwelling's full risk premium rate. Under the Biggert-Waters Reform Act, if the property covered by a policy using subsidized rates is sold on or after July 6th of 2012, the policy must be full risk rated beginning with policies effective on or after October 1st of 2013. Larry and Mary Laketon eventually purchased Doc & Dot's house. A surveyor completes an elevation certificate for them, and it indicates that the house is 4 feet below the base flood elevation. The Laketon's insurance agent makes a submit for rate submission to his Write Your Own carrier to have a full risk rate determined, since rates with a -4 elevation are not published in the NFIP Flood Insurance Manual. The Write Your Own carrier utilizes the 2013 specific rating guidelines to develop the Laketon's premium, which totals $10,723 with a -4 elevation difference. The specific rate guidelines are a complex series of tables of rates and technical underwriting procedures which are used by insurers to calculate premiums for their policyholders. They historically have been used by insurers to calculate premiums for a variety of special cases that have a much higher risk of flood damage than typical, even within the special flood hazard area. In order to lessen the impact of full risk rates, the Laketons may need to examine how they can mitigate their flood risk and lower their premiums at the same time. Elevating their structure will lower their flood risk and could reduce their premium. They could also consider adding flood vents to their foundation walls, if appropriate. Although there are some significant initial costs involved in such mitigation efforts, the Laketons can recoup some of that investment in lowering their flood risk by looking at the money they do not spend on flood insurance premiums. Let's take a look at an example. If they were to elevate their house to the base flood elevation, their premium for the same amount of coverage would be reduced to $1,815 a year, saving them nearly $9,000 a year in flood insurance premiums. Let's look at one more example. If the Laketons elevated their home to 2 feet above the base flood elevation, which is the standard freeboard provision adopted by communities in Indiana, their premium for the same amount of coverage would be just $667 per year, a savings of over $10,000 a year in flood insurance premiums not paid that can be used to offset the mitigation expense. For more information on full risk rating and mitigating flood risk, see fact sheets on rebuilding in A and V zones, and also see a homeowner's guide to the elevation certificate at www.fema.gov/Flood Insurance Reform Act 2012.